Welcome to this update on Bitcoin's evolving role in global finance. Bitcoin is increasingly viewed as a potential reserve asset by central banks, akin to gold due to its fixed supply, low correlation with traditional assets, and declining volatility, with Deutsche Bank forecasting its inclusion in reserves by 2030. Analysts at VanEck project Bitcoin could comprise up to 2.5% of central bank reserves by 2050, serving as a hedge against monetary risks amid diversification from the US dollar. The Czech National Bank has begun testing a small Bitcoin portfolio separately from its main reserves to gain practical experience with digital assets, signaling early adoption steps among institutions.
Central banks cite several key risks when considering Bitcoin holdings, primarily focusing on its extreme price volatility, which can lead to massive value swings unsuitable for stable reserve assets. They also highlight concerns over financial stability, as Bitcoin's decentralized nature could undermine monetary policy control and amplify inflation or deflation risks if widely adopted. Additional worries include heightened vulnerability to cyber attacks, money laundering facilitation, lack of legal backing or government guarantees, custody challenges like key loss, and potential regulatory conflicts with anti-money laundering standards.
Volatility concerns. Bitcoin's price can fluctuate dramatically, sometimes thousands of dollars in hours, exceeding central banks' risk tolerance for reserves, unlike traditional assets like gold or bonds. Security and crime risks. Holdings become prime targets for nation-state hackers and cyber threats. Irreversible transactions enable illicit finance, prompting fears of sanctions evasion and economic disruption. Stability and policy issues. Unbacked by governments, Bitcoin risks eroding trust in fiat systems, complicating policy and sparking capital outflows in vulnerable economies.
Could Bitcoin holdings threaten financial stability? Bitcoin holdings by central banks or widespread adoption could threaten financial stability under certain conditions, primarily through extreme price volatility that amplifies wealth effects and erodes confidence. Reports from the Financial Stability Board and ECB highlight risks like liquidity mismatches in related stablecoins, leverage and crypto trading platforms, and potential spillovers to traditional markets if institutions hold significant unbacked assets like Bitcoin.
While current market size remains small relative to global finance, rapid growth and interconnections such as banks' direct exposures could trigger defaults, capital outflows, or contagion during downturns, as seen in past crypto crashes. Key transmission channels. Unbacked crypto assets like Bitcoin impact stability via wealth destruction from price drops, confidence shocks from platform failures, direct financial sector losses, and payment system disruptions if used broadly. Mitigation factors. Regulators note that enhanced oversight, limits on leverage, and stablecoin reforms could curb threats, though opacity and cyber risks persist without global coordination. How do stablecoins differ in systemic risk from Bitcoin holdings? Stablecoins pose greater systemic risks than Bitcoin holdings for central banks due to their design as payment instruments with redemption promises tied to fiat reserves, amplifying run risks and spillovers to traditional finance. Bitcoin, being a decentralized store of value without counterparty obligations, primarily threatens stability through price volatility and indirect wealth effects, lacking the maturity mismatches or bank deposit concentrations seen in stablecoins.
Run and liquidity risks. Stablecoins face rapid depegging during stress, as in Terra USD's 2022 collapse or USDC's SVB exposure, potentially draining bank deposits and mimicking money market fund runs. Bitcoin avoids this by having no fixed peg or issuer solvency dependence. Interconnection differences. Stablecoins reserves, often in treasuries or uninsured bank deposits, create direct links to conventional markets, enabling contagion. Bitcoin's isolation limits spillovers despite its volatility. What reserve assets do major stablecoins hold today? Major stablecoins like Tether, USDT, and USDC primarily hold short-term U.S. Treasury bills, cash equivalents, and cash as their reserve assets to maintain their $1 peg. Tether diversifies further with holdings in Bitcoin, gold, secured loans, and other investments, comprising about 65% treasuries alongside these riskier elements. USDC sticks to a conservative mix of U.S. treasuries, around 44%, and cash/cash equivalents, 56%, emphasizing liquidity and transparency through regular attestations.
Bitcoin is gaining traction as a reserve asset among central banks, with Deutsche Bank forecasting its inclusion in official reserves by 2030 due to declining volatility and gold-like properties as an inflation hedge and diversification tool. The Czech National Bank recently purchased $1 million in Bitcoin alongside stablecoins for practical testing of custody and processes, signaling early adoption amid US dollar concerns driving gold purchases. Meanwhile, the US established a strategic Bitcoin reserve in March 2026, holding around 325,000 to 328,000 BTC, positioning it as the largest sovereign holder, while analysts note Bitcoin's low correlation with traditional assets supports complementary reserve status.
Legal and regulatory steps supporting central bank crypto holdings have advanced notably in 2025-2026, primarily through U.S. policy shifts under President Trump and targeted authorizations elsewhere. The U.S. Treasury's OCC issued Interpretive Letter 1188 in December 2025, permitting national banks to conduct riskless principal crypto transactions and approving national trust charters for 5 digital asset firms like BitGo, Fidelity Digital Assets, Paxos, Circle, and Ripple, facilitating safer custody and integration. The FDIC rescinded prior crypto activity notifications in April 2025, issued joint risk management guidance with OCC and Fed in July 2025, and advanced Genius Act rules for stablecoin issuance by bank subsidiaries by January 2027.
Central banks issued mixed statements on Bitcoin holdings in 2025-2026, balancing caution with exploratory steps. Federal Reserve Chair Jerome Powell stated in December 2024 that the Fed is legally barred from owning Bitcoin and has no interest in changing that, deferring such decisions to Congress. ECB President Christine Lagarde emphasized in January 2025 that reserves must be liquid, secure, and safe, dismissing Bitcoin due to its volatility and risks like money laundering.
Before investing in Bitcoin or any cryptocurrency, always conduct your own due diligence. Consult financial advisors and assess your risk tolerance. Markets remain highly volatile despite growing institutional interest. For more insights on Bitcoin's role in reserves, financial stability risks, stablecoin differences, and beyond, subscribe to our channel, Bitcoin's anchor effect and hit the notification bell today.